Good afternoon, ladies and gentlemen. I'm conscious, no matter how interesting I think I am, that you've been here for a very long day, and I think I stand between you and your coffee break. So I will try to remember to keep on focus for you so that you get out near time. I'm very pleased to be invited to be here today, and I want to focus my remarks on three elements that are of interest to us regulators. I want to talk about the opportunities and risks posed to consumers by technological developments, which is apt given the themes that you're considering today. I want to tell you a little bit about our regulatory approach to conduct, and particularly consumer risk protection in a rapidly changing environment. And I want to talk a little bit about the new central bank proposals to drive conduct standards and enhance individual accountability. So it's almost actually 40 years in Ireland since an ATM was first introduced. Now, it promised to allow banks and banks' customers to transact business in a revolutionary way. You could do your banking transactions outside of hours, self-service, and we really thought we were looking at a revolution. But if we thought back in 1980 that the ATM would change the face of financial services, I think it pales into insignificance when compared with what's actually happening today. We've already seen that the widespread internet, smartphone, and tablet use has changed how people manage their finances, with many now choosing to bank, invest, and insure through digital channels rather than to even engage with a human or go to a branch. Many of us have already embraced digital innovation. We ourselves open our own bank accounts, I'm sure, over the internet without physically entering a bank branch. We link into those accounts over our phones. We monitor our transactions through our mobile devices. We use our smartphones as digital wallets, and it moves on. In insurance, we buy telematic-based insurance where our driving is monitored using data collected via our smartphones or black box fitted in our cars. And this is really just the beginning. The fourth industrial revolution is bringing intelligent robots, self-driving cars, and a range of new technologies that are fusing physical, digital, and biological worlds. Now, the central bank is aware that firms in banking, payments, and insurance sectors are examining the potential use of innovative technologies, including artificial intelligence, machine learning, blockchain, biometrics, robotics, and even virtual and augmented reality. Firms now gather, as you well know, vast volumes of data about consumers, and those consumers leave an information trail behind them when they go online. Firms can then use that data to target products and services even more effectively. We know that the use of data analytics is already apparent in the advertising of products and services to consumers in Ireland and, of course, globally. Data analytics enables firms to target advertisement far more effectively than previously, particularly in your social media platforms. I'll confess to being a Facebook user, and I know that's old technology now, but I'm astonished with the kind of bespoke ads that are pushed forward to me. So this is everywhere, and it's now, and we're already seeing future innovations. More profoundly, the use of consumers' pattern of life data has the potential to drive the development of personalized financial products and services. Now, this includes, for example, consumer data to assess a consumer's creditworthiness or to help you assess the suitability of a range of products from mortgages to motor to health insurance. You only have to look around you to see how rapid change is happening as traditional underwriters and technology startups seek to combine the regulatory and underwriting expertise of incumbent insurers with the innovative solutions provided by technology companies. Often, tech firms provide a digital platform, website, or app that allows consumers to access a traditional insurance product. In other cases, technological solutions are applied to other parts of the insurance value chain, such as claims. Now, just last month, the US insurer John Hancock said that in future, all of their life insurance policies would come with digital fitness tracking technology that will incentivize healthier choices linked to physical activity and nutrition. That move came after that US insurer said it had found that users of that technology lived longer, generated lower hospitalization costs than the rest of the population. We also know that the UK operator Revolut has developed an innovative travel insurance offering. When a customer travels abroad with their phone is triggered in a different jurisdiction to offer them pay-as-you-go daily travel insurance cover. This is the world that we live in today. So I know that consumers will actually likely welcome all of these and many of these innovations. Just like we embraced an ATM back in the 1980s, we will see that a lot of these new technological benefits will bring speed, convenience, choice, cheaper deals, and more personalized products, all to the good. But the late Professor Hawking said, "Our future is a race between the growing power of technology and the wisdom with which we use it." So, some worry that the future will not necessarily be a consumer utopia. Already there are concerns that the use of personal data in the airline industry will actually use algorithms unless you pay to sit with your family to ensure that you don't. That we are looking at loyalty penalties on customers who fail to shop around. And of course, there's concern that technological advances potentially challenge the fundamental ideas of insurance provision itself, the pooling of risk. As underwriting becomes more and more personalized through the use of data, we have to think about how we use this information. So the central bank must keep abreast of technological innovation in the same way that you do to be leaders in your business. We need to understand the developments and be in a position to regulate them in line with our legal mandates. And in that regard, we've taken some practical steps to put ourselves in a position to do so. Now, for many years, the central bank has had a long history of engaging with the firms that it regulates, and different divisions of the bank would be very au fait with the technological advancements taking hold in a particular industry sector. But as the impact of new technologies continue to increase, we thought to enhance and coordinate this engagement in a more proactive way. The result of that is an innovation hub which enables innovative firms to contact the central bank with questions about navigating the strange landscape of financial services regulation. And of course, there's a benefit to us as regulators because it enhances our sight of where financial services are headed. And that's very important for us. We are connected both in Europe and internationally in terms of the digitization agenda, fintech and insurtech developments. In EIOPA and elsewhere, we participate in assessing the benefits and the risks of digitalization, impediments to innovation, the use of big data by insurers and intermediaries. EIOPA has incorporated insurtech into ongoing priorities in order to assess the impact that digitalization is having on both consumers and on industry, with a view to identifying supervisory approaches that allows innovation to flourish, but takes legitimate consideration of the requirement for consumers to remain protected and to benefit from the innovation. Now, the Central Bank of Ireland's legal mandate is the proper and effective regulation of financial service providers and markets, ensuring the best interests of consumers of financial services are protected. Our vision is to seek to achieve an industry that is trustworthy and resilient, a system that sustainably serves the needs of the wider economy and the customers that they serve, where regulated firms and individuals adhere to a culture of fairness and high standards. Particularly from the perspective of conduct regulation, we want to make sure that consumers and investors continue to be protected, irrespective of the manner in which they engage with the firms that serve their needs. Technology is important, but it is irrespective to the outcomes that we seek for consumers. So the same principles of regulation must apply. The rules of the Consumer Protection Code must apply equally to both digital and traditional delivery channels. Now, every year, the Consumer Protection Directorate of the Central Bank carries out a risk assessment of the landscape of risk facing consumers. It includes both traditional and digital channels. And certainly the possibility that digitization will confer great benefits on consumers is certainly a factor. We need to monitor the risks posed by these channels. There could be implications for the visually impaired, for the elderly, for rural consumers, but that's all within the gift of firms to address and mitigate. But of course, there's firm risk too, where you don't keep up with technological innovation or master the IT systems that you have. Both traditional and digital sales channels can contain risk for consumers, so both need to be managed. Algorithms and robo-advice need to conform to the regulatory framework in the same way as is required of the traditional channel, so that the customer's interests are both served. To address any conduct risk, robo-advice must have responsible oversight, and firms must manage the risk that the increased volume of online transactions will pose to their business. But the greatest risk to consumers comes not from technological development, but from the people who are in charge of implementing the technological innovation. If you put new technology in the hands of people and firms who have the best interests of consumers at heart, it is far more likely that you will get positive consumer outcomes. And that is where culture comes in. It's hard to define culture, but you can think of it as a system of shared values and beliefs and norms. They shape the behavior and mindset within a business, the unwritten rules, more colloquially, the way we do business around here. And we think that the absence of a consumer-focused culture is the single greatest risk posed to consumers, irrespective of the channel through which they engage with the firm. So, from a regulatory and a supervisory perspective, we have increasingly focused on conduct and culture and the risks that they bring to your customers. But it's fair to say that treating your customer fairly has been at the center of the regulatory framework since 2006. It's embedded in the Consumer Protection Code, and although an old-fashioned value, it hasn't gone out of fashion, and nor will it in the future. And in fact, that principled way of looking at things will become more and more significant in the future because of the increasing use of automation and technology in the delivery of products and services to customers. Customers need help in making their financial decisions, and they need to be protected in that context. They have to be able to trust you as the professionals who design and sell insurance products to them, that you indeed have their best interests designed into the way that you run your business. This is required from the firms and the people who run those firms, because the key driver of consumer risk sources at governance, product design, product oversight, the sales channels, the incentives that are used to sell those products. Insurance products are not visible in the way that other consumer goods are. Consumers can't see or touch what they are buying, and it's difficult for them to understand whether it in fact will meet their needs now and into the medium and long term. Any flaw may not surface for a number of years. It may have a latent defect. That product may not be suitable for their needs. They may not be the appropriate target group to purchase that particular product. So it makes it just all the more important that you, as the insurance professionals who do understand the products and sell those products, ensure that they meet your customers' needs. That's good business in the long run for customers and for professionally run businesses. Last year, the central bank designed a consumer protection risk assessment and shared our new approach with industry. We are going to look at consumer protection risk, as I've referenced earlier, through governance and design, product oversight, the sales channels and the incentives that are
being used. We will look to see if the needs of the customers are being met and if those products are being sold in the right way. Where problems arise, we'd expect them to be addressed, and we would expect that learning to be applied right across the business. We also discussed last year digitisation of financial services, and we'll take account the feedback that we received in the digitisation consultation when we look to review and rewrite the Consumer Protection Code next year. But the key message for you, I hope you have discerned it, is that we are in fact technologically neutral. We are agnostic to the delivery channels by which you interact with your customers. Their expectations of fair value and fair outcomes must be met, whether they're buying insurance from Alexa in the cloud or Sean on the high street. Internationally, it's in fact recognised that culture and conduct are of more and more significance. And some of you may be aware that the Central Bank published a culture report into the conduct and behaviours of the main retail banks in Ireland earlier this year. And in that report, we recommended to the government that there would be an individual accountability regime akin to the senior managers regime in the United Kingdom. We are recommending that these proposals apply beyond the banking sector, in fact, and also apply to certain undertakings in the insurance area and investment firms, where we see that they pose risk prudentially and from a conduct perspective to consumers. In that framework, we propose what I would think is no more than what a well-run business or ethical participants in that business would adhere to in any event. We propose principles that people be required and the businesses be required to act honestly, ethically, and with integrity, with due skill, care, and diligence, be open and cooperative with the regulator, and importantly, act in the best interests of customers and treat them fairly, and of course to observe proper standards of market conduct. The increased focus we are now placing on people, conduct, and culture is particularly apt in the context of rapid technological development. For depending on in whose hands this technology rests, it can be used to the benefit or to the detriment of consumers and investors. And I certainly would like to think that the people in this room today would use the amazing array of technological innovation to the benefit of their customers and to nudge their customers to make the right decisions. Thank you for listening to me and your time.